what we're watching, this big trend unfolding, is a destruction of wealth. It might protect the US dollar in terms of its trade, where it continues to be the dominant currency in trade, but that's unlikely to happen where that currency itself is valued more than underlying hard assets.
Debt. I know you love talking about debt, Chris.
This is the elephant in the room that right now people are not paying any attention to. Okay, you can see from the chart there, forget about the top two for the minute. World War II was where, 103%, right? So basically when we got to COVID, we were at the same debt levels as we were in a wartime. Today, you can see we've gone way past that. We blew through that little boy and just kept going. And we're not yet ostensibly at war, although I would argue that we sort of are to some degree. So this debt is completely unpayable. That's the important thing. We've got 175.3 trillion, which doesn't account for some of the other unfunded liabilities. It's unpayable. It's completely unpayable. That anyone with the math and a brain can figure out. And the question is, how does that get paid? It gets paid either by default or by printing. And if you go back to, say, 2020, what we can see is already that the US dollar relative to hard assets has lost about 20% of its value. You know, right now you could look and you could say, oh, you know, maybe your portfolio's down 20% or whatever the case might be. That's a volatility issue. What we're watching, this big trend unfolding, is a destruction of wealth in terms of inflating away the currency. They tend, these over the course of history, what tends to happen is things go kind of slowly and then they go all at once. There's an argument that has been made of, you know, can't the US go to war to protect its currency? Well, certainly that's something that might be tried. But if that's true, it might protect the US dollar in terms of its trade, where it continues to be the dominant currency in trade. But that's unlikely to happen where that currency itself is valued more than underlying hard assets, which Brad, you just made an excellent case for with respect to the supply-demand imbalance. Your probability of that taking place is extraordinarily low. The only way they're going to pay off this debt is by inflating it away. And if they go to war, wars are financed with debt, and the debt levels will increase. We already have, if you look at that, so this is where the chart on the top right comes in, that white line is your interest bill on the debt. It's screaming higher, absolutely screaming higher. It is now bigger than military expenditure, which is quite something given the US's level of military expenditure. All of this stuff is going to need to be financed. You got to be able to finance the deficit spending, and you got to be able to finance increasing wars. Like I said, they've just sailed 2 battle carriers into the Persian Gulf, and if anybody watched Netanyahu's speech in front of Congress a couple of weeks ago, it was very clear that you will all go to war for us, and that probably includes much of the Western, quote-unquote, civilized world, at least from Netanyahu's perspective. He'd like to call it the civilized world. Bit of an embarrassment, but nevertheless. So we are moving towards some conflict, or at least a probability of that. That always gets financed. It has to be financed. Again, you look at the debts already. So in that environment, if you see that you're moving towards that environment, not owning some assets that protect you from that inflationary, or I'd say hyper stagflationary environment, I think is a very, very dangerous position to be in.